Welcome back to the channel. Today, we're diving into the world of volatility indicators, those crucial tools that can help you level up your trading game. You see, understanding volatility is like having a superpower in the market. It's about knowing when a stock is just chilling out versus when it's about to make a big move, up or down. These tools help measure those price fluctuations and identify potential breakouts in the market. By the end of this video, you'll know exactly which indicators to use to make smarter trading decisions. Let's get started. First up, we have Bollinger Bands, one of the most popular volatility indicators out there. Now, I know standard deviation might sound intimidating, but trust me, it's actually pretty straightforward. Picture this: you've got a stock's moving average, right? Think of that as the center line. Bollinger Bands create these upper and lower bands around that center line, and those bands are calculated using, you guessed it, standard deviation. Think of standard deviation as a way to measure how spread out the price action is. When the bands are narrow, it means the stock is trading in a tight range, kind of like it's taking a breather. But when those bands widen, watch out. It means volatility is picking up, and a big move could be on the horizon. Now here's where it gets really interesting. See, Bollinger Bands can also act like support and resistance levels. When a stock price bounces off that lower band, it could be a buy signal. And when it hits the upper band, that might be your cue to sell. Next, we're going to talk about the average true range, or ATR for short. This indicator is all about measuring volatility over a specific period, like, say, the past 14 days. It looks at the difference between the high and low prices each day, and then calculates the average of those ranges. Here's why this is so cool. ATR gives you a sense of how much a stock tends to move on a daily basis. A high ATR means the stock is making big swings, while a low ATR means it's relatively calm. This information is super valuable for setting stop-loss orders and figuring out your profit targets. Let's say you're looking at a stock with an ATR of $1. That means on average it moves up or down by $1 each day. So if you buy in, you might set your stop-loss order $1 below your entry point to avoid getting shaken out by normal price fluctuations. Now let's talk about Keltner channels, another powerful tool that incorporates the average true range. Remember how Bollinger Bands use standard deviation? Well, Keltner channels use ATR to create those upper and lower bands. But here's the twist. Instead of being plotted around a simple moving average, Keltner channels typically use an exponential moving average, or EMA. This EMA gives more weight to recent prices, making it more sensitive to changes in momentum. The cool thing about Keltner channels is they can help you identify not only volatility, but also potential trend reversals. When the price breaks out of the channel, it could signal a shift in momentum. For example, a breakout above the upper band might indicate a bullish move, while a breakdown below the lower band could suggest a bearish trend. Next up, we have Deviations channels, a volatility indicator that keeps things super simple by focusing on the highest high and lowest low over a set period, usually around 20 periods. It's like looking at the outer boundaries of where the price has been trading recently. Now here's where it gets interesting. Traders use Deviations channels to spot potential breakouts. Think of it like this: if the price breaks above the upper band, it could signal a surge in buying pressure and the start of a new uptrend. Conversely, if it breaks below the lower band, it might indicate a wave of selling and a potential downtrend. One of the key advantages of Deviations channels is that they're super easy to understand and use. You don't need a degree in rocket science to figure them out. Just look for those breakouts above or below the bands, and you'll be well on your way to identifying potential trading opportunities. Last but not least, we have the Chaikin Volatility Indicator, a tool that measures the difference between the high and low prices of a stock over a specific period. It's like taking the temperature of the market. Is it heating up or cooling down? Here's how it works. The Chaikin Volatility Indicator looks at the difference between the current period's high and low, compares it to the difference between the high and low of a previous period, and then calculates a moving average of that difference. Sounds complicated, but the idea is actually pretty simple. When the indicator is high, it means the difference between the highs and lows is widening, indicating increased volatility. Conversely, when the indicator is low, it means the price range is narrowing, suggesting decreased volatility. Traders use the Chaikin volatility indicator to confirm breakouts, identify potential trend reversals, and even gauge the strength of a trend. It's like having an extra set of eyes on the market, helping you make more informed trading decisions. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more trading tips and strategies. Understanding volatility is crucial for any trader who wants to succeed in the market. By incorporating these indicators into your analysis, you'll gain a significant edge, allowing you to make smarter trading decisions and potentially boost your profits. Now, I want to hear from you. Let us know in the comments which volatility indicator you use the most and how it's helped you in your trading journey. Remember, knowledge is power, and the more you learn about trading, the better equipped you'll be to navigate the exciting world of the financial markets. Happy trading!